In 1973, something happened that most people didn't notice at first. A small group of oil ministers raised the price of oil. Within months, gas stations across America ran out of fuel. Drivers waited in lines for hours. Truck drivers began blocking highways. Entire industries started to panic. But the most interesting part of the crisis wasn't the shortages. It was the money. Some oil companies were making record profits, yet their stock prices were falling. Gold exploded in value. Then suddenly it stopped. Farmland prices quadrupled, before collapsing and bankrupting thousands of farmers. And the biggest fortunes of the entire crisis, they were made by people who didn't own oil at all. They owned the ships that moved it. This is the hidden financial story behind the world's energy crises. A story about panic, unexpected winners, destroyed fortunes, and the economic forces that reshape entire industries. Because when energy shocks hit the global economy, the obvious winners are rarely the real winners, and understanding why might change the way you see every future crisis. Let's start with the meeting that triggered it all. The day the oil market changed forever. October 16th, 1973. Inside a hotel conference room in Kuwait City, several oil ministers from the Persian Gulf gathered for a meeting that would quietly change the global economy. For decades before this moment, the price of oil had largely been controlled by Western oil companies. The producing nations supplied the resource, but they did not truly control its value. That day, the Saudi oil minister, Ahmed Zaki Yamani, walked into the room with a different idea. Instead of negotiating with the oil companies, the oil-producing countries themselves would set the price of oil, not months later, not after discussions with corporations. Immediately, within hours of that decision, the official price of crude oil jumped from roughly $3 a barrel to $5. But that was only the beginning. In the months that followed, the price surged even higher, eventually reaching nearly $12 a barrel. For the modern world, this was more than just a price increase. Oil was the foundation of transportation, industry, and electricity. When the price of energy suddenly multiplies, the shock spreads through the entire economy. Factories pay more to produce goods. Trucks pay more to move them. Consumers pay more for almost everything they buy. The decision made in that Kuwait meeting room did something few political decisions ever achieve. It reshaped the global balance of economic power almost overnight. And the consequences were only just beginning. The shock spreads across the economy. When oil prices began to rise in 1973, the consequences appeared faster than most governments expected. Energy was the backbone of the modern industrial world. When the cost of oil increased, the cost of nearly everything else followed. Transportation became more expensive. Airlines struggled with rising fuel costs. Trucking companies had to pay far more to move goods across long distances. Factories that depended on oil and electricity suddenly faced higher production costs. Within months, the shock from energy prices spread through the entire economic system, but the most visible impact appeared at gas stations. Across the United States, fuel shortages began to appear almost immediately. Gas stations started running out of gasoline, sometimes before noon. Drivers lined up in their cars for hours, hoping the pumps would still have fuel when their turn arrived. In many cities, the lines stretched for several miles. The situation became so severe that several states introduced rationing systems. Some places allowed drivers to buy fuel only on certain days, based on the last number on their license plate. If your number didn't match the day, you simply could not buy gasoline. For many people, this was the first time they realized something important. Energy was not just another commodity, it was a strategic weapon capable of disrupting entire economies. Government tries to take control. As the crisis intensified, the American government stepped in with urgent promises and new policies. On national television, President Richard Nixon addressed the country with a bold declaration. The United States, he said, would achieve full energy independence before the end of the decade. The plan was called Project Independence. Its goal sounded simple: produce enough energy at home so the country would never again be vulnerable to foreign oil disruptions. But behind the confident speech was a much more complicated reality. America was already heavily dependent on imported oil, and domestic production alone could not easily replace it. Despite the ambitious promise, the country's oil imports actually continued to rise in the years after the announcement. At the same time, the government introduced strict controls on oil prices inside the United States. Domestic oil prices were capped to keep gasoline affordable for consumers, while global market prices kept climbing higher. At first glance, this seemed like a solution, but economics has its own rules. When producers are forced to sell their product below market value, they have little incentive to produce more. Oil companies slowed drilling, refineries struggled to obtain crude oil, and the shortage became even worse. In trying to control the crisis, the policies unintentionally deepened it, the era of gasoline lines. By early 1974, the consequences of the oil shock were visible everywhere in America. Nearly 1 out of every 5 gas stations had completely run out of fuel. For drivers, finding gasoline had become a daily struggle. Cars began forming lines long before sunrise. In some cities, those lines stretched for miles down highways and city streets. Drivers waited patiently, sometimes for hours, hoping the station would still have fuel when their turn finally arrived. To manage the shortage, several states introduced strict rationing systems. In places like New Jersey, drivers were only allowed to buy gasoline on certain days depending on their license plate numbers. If the last number on your plate was odd, you could buy fuel on odd-numbered days. If it was even, you had to wait for even-numbered days. Other states introduced additional restrictions. Some gas stations closed entirely on weekends to conserve fuel supplies. Meanwhile, the federal government imposed a national speed limit of 55 miles per hour in an attempt to reduce fuel consumption. But instead of calming the situation, these measures often made the lines even longer during the days when gas stations were open. For millions of Americans, the oil crisis transformed an ordinary routine filling up a car into a symbol of economic vulnerability, and the world was beginning to realize something important. Control over energy meant control over economic stability. When shortages turned into conflict, as the fuel shortage dragged on, frustration began turning into anger. What started as long lines at gas stations slowly evolved into something much more tense. Truck drivers, who depended on fuel for their livelihood, were among the hardest hit. Many of them began organizing protests and strikes across different states. High fuel prices and limited supply were threatening their businesses, and they wanted immediate action. In some areas, the situation escalated dramatically. On highways in states like Pennsylvania and Ohio, striking truckers attempted to stop other drivers from operating normally. Some trucks were attacked for refusing to join the protest. There were reports of vehicles being damaged and even gunfire on certain highways. For a country that had not experienced war on its own soil, this level of internal disruption was shocking. The crisis revealed how quickly economic pressure could lead to social tension, but the chaos at gas stations and highways was only one part of the story. Behind the scenes, investors and economists were beginning to study something far more important. They wanted to know which assets actually survive when energy becomes a geopolitical weapon. The question investors always ask. Every major crisis eventually leads to the same question. When the world becomes unstable, what actually protects wealth? During energy shocks, the answer is rarely as simple as people expect. When oil prices explode, most people assume oil companies must automatically benefit. After all, if the price of their product rises dramatically, their profits should rise as well. But history shows something surprising. During the 1973 oil embargo, when oil prices quadrupled, many of the largest oil companies still saw their stock prices fall sharply. Even companies reporting record profits could not escape the pressure of the broader market. One example was Exxon. The company earned billions in profit during that period, yet its stock price still declined along with the rest of the market. Why? Because when investors panic during a large economic shock, they often sell everything. It does not matter if a company is profitable. In a deep market downturn, fear spreads faster than logic. This reveals one of the most important lessons of financial history. In the early phase of a crisis, almost every asset can fall together, even the ones that seem like obvious winners. Time changes everything. While many energy companies struggled during the early phase of the 1973 crisis, the story looked very different over a longer period of time. In the short term, panic dominated the markets. Investors rushed to sell stocks as recession fears grew, but as the decade continued, the rising price of energy slowly reshaped the entire economy. Companies involved in oil production, drilling, and energy infrastructure began benefiting from a new reality. Energy had become far more valuable than it had been in previous decades. Between 1970 and 1980, energy sector stocks dramatically outperformed the broader market. While many industries struggled with inflation and slow economic growth, oil-related companies generated massive returns over the decade. This created an important lesson for investors. Timing matters just as much as the asset itself. Someone who bought energy stocks during the first panic of the crisis might have lost money for more than a year, but someone who held those same investments through the entire decade saw extraordinary gains. History shows that crises often reward patience rather than speed.